After the Fed, markets wait for more clues on the Fed. Welcome to Market Insight. I'm David Pollard. The S&P 500 and the blue chip Dow closed at record highs on Monday after a survey showing steady business activity soothed recession concerns and as a number of policymakers supported further policy easing by the US Central Bank. This in a week where Jerome Powell himself is due to speak and where data puts the consumer and inflation in focus. Well, Keith Gangle, Portfolio Manager at Gradient Investments, is with me. Welcome, Keith. There are clear signs policymakers have been getting very worried about downward pressure on the jobs market. Do you think they've done enough to correct that downward pressure? Are we heading for a soft landing in the US or possibly much worse?
No, I think we're heading for a soft landing. The Fed did a good job of getting in front of this. Obviously, last week they cut 50 basis points, which is a little bit more than expected. I mean, the market was debating whether it's going to be 50 basis points or 25. We thought maybe 50 basis points would worry the market. Doesn't seem to be the case. The Fed did a good job of explaining why they're cutting 50 basis points, and I think they started the process, and that's going to continue. So that should be a tailwind for the overall markets.
Let's look at the other side of the argument, which is that still quite perky Treasury yields indicate that inflation could still be a worry for the central bank. And today, Fed Governor Michelle Bowman echoed those concerns. Is it a view you share at all?
Yeah, we have to keep an eye on the inflation for certain. I mean, it's a dual mandate of the Fed policy. It's, stable employment, which, it's creeped up here a little bit. The last number we saw unemployment was at 4.2%. The other mandate that we've been worried about for the last 2 years has been inflation. They've got it down from the over 9% in 2022. Now the latest numbers at 2.5%, so it's definitely coming down. But they have a little more work to do to get to that 2% goal there. So that's why we have to keep an eye on it. That's why we would not want to see continued 50 basis points cuts, because I think that could reignite the inflation worry. So I do think after this initial 50 basis points cut, maybe we start going to more like the 25 and keep that on a nice little pace for the next year.
So what's your take on the consumer? We have the University of Michigan survey later in the week. Today's conference board numbers shock to the downside. Is this still the potential weak spot in the outlook?
Yeah, we have to keep a close eye on the consumer. But again, like I go back to the unemployment number at 4.2%. When the U.S. consumer is working, they have money in their pockets. They love to spend. What's going on with the consumer right now? They're tightening their belts a little bit. They're looking for value. And that's kind of the stuff that we're looking for when we're investing in.
So what does that mean for the budget retailers like Costco, who are reporting later in the week? Are they still a good bet for portfolio managers, or are valuations getting rather too high there?
Valuations are getting high, but this is a core holding. They are passing on the value to the consumer. They're making the suppliers eat that cost, and they're passing on to consumers. And they continue to grow their EPS at a great rate, and they're doing comps of like 7, 8, 9%. That's a huge for a company this big. So it's a Costco is a name we like. Again, they're focused on value. They're passing on to consumer, and that's why we want to continue to stay with this name.
Now, Gradient Investments, like many others, they're still pretty keen on chip makers like Nvidia, Broadcom, and so on. Those stocks are obviously boosted by a lower rate environment, but are they anywhere near reasonable valuations?
I do think they're very reasonable. If you actually look at, whether it's Nvidia, AMD, Broadcom, they're all trading with the next year. If you look at their PE multiples, which kind of one of the ways we value these stocks, they're trading at 28, 29, 30 times multiples, which the overall S&P 500 is trading at 21 times. So yes, on the headline, they're expensive. But you look at their underlying growth rates, they're fantastic. They're 40, 50, 60% on some of these names. So again, if you look at valuations, a little bit high on PE, but what you're getting for that growth rate, we think those are good names to be owning.
Now, another developing story you've been watching is the potential deal for Qualcomm to buy Intel. Is that attractive, or does it make a bad fit in potentially burdening a smartphone chip maker with a loss-making semiconductor manufacturing unit?
Yeah, we're sitting out on this deal. We don't either own Qualcomm or Intel. Intel's just been a really bad stock for the last several years. Their earnings have actually been down. They're still below where they were 4 years ago. Now we talk about those other semiconductor companies. They've actually doubled, maybe tripled their earnings in the last few years. Intel's in the opposite boat. I'm not exactly sure why Qualcomm would want to get involved with Intel at this point in time.
Okay, Keith, we'll leave it there. Keith Gangle of Gradient Investments, many thanks for sharing your thoughts with us today. That is your Market Insight. You can watch more videos on Reuters.com.